Let's bring in Brent Joyce, Chief Investment Strategist and Managing Director at BMO Private Investment Counsel. Great to see you. What has been jumping out for you in the markets over the past week or so?
Well, certainly the 5,000 number, right? We can look at a lot of different technical levels, and then we have some levels that really aren't so technical, but they're certainly psychologically important. And that's the 5,000 level for the S&P 500. It's just a number. Certainly corresponds with a new all-time high, and we've been getting a lot of inquiries. Okay, market's now recovered, new all-time high. What should I do? What should I do? Right? And the reality is, new all-time highs are nothing to be afraid of. All right, equity markets, quite frankly, they're on this planet to make new all-time highs.
That's right. And inflation means they should be, I suppose.
Exactly, yeah. Exactly. And so, no fuss, no muss over 5,000. It will bobble around here likely. As you mentioned, it's been a strong run, particularly for U.S. stocks off the late October lows. And so we would expect to see, we need to see some consolidation here. And the catalyst is obviously going to be this shifting landscape on inflation and rate cuts.
So the Fed has been at pains to say we're not cutting interest rates soon, or at least in the immediate future. Do you think investors are fighting that by bidding stocks in the States up to new all-time highs?
It certainly is the way to go. I mean, if you look at, if inflation is your problem as an investor, that's a bigger problem for bond investors than it is for equity market investors, for stock investors. You know, we certainly like stocks as an inflation hedge. Companies are part of the inflation machine, right? If you don't have companies raising prices, you don't have inflation. Yeah. And so it really comes down, to profit margins at this point. And so if, as far as things to be afraid of as an equity investor, inflation's on the list, but it's not as high up as it would be for a bond investor.
I know critics of corporations have been saying their numbers demonstrate that corporate profit-taking has been a big factor in inflation, but it's hard to untangle all the strands, really.
Yeah, we definitely saw a spike in profit margins. This is capitalism. When you have excess demand and restrained supply, like we had coming out of the pandemic, what's a capitalist to do? All right, I mean, that's a good problem to have. And so you would see profit margins expand, and some industries more than others. We've largely normalized that back down to its level that is typical in a non-recessionary environment, which I think bodes well for risk assets as we move through 2024. I
think you have a chart showing the profit margin over quite a period for the S&P 500. So it's off its highs, but it's certainly, it has moved up pretty sharply over the years.
Yeah, there's a very long history here, right? Yes. We're looking at almost 40 years.
Right, it's a gross margin, I believe.
That's right,
yeah,
yes.
Okay, carry on, sorry.
And so you can see the big dips in recessionary periods. That's not a surprise. The economy collapses and profit margins go with it. The one that stands out is the spike on the far right-hand side, and that's the COVID period. And like so many charts that have been disrupted because of the pandemic, profit margins were another one, all right? And it sparked all kinds of conversations about greedflation and that sort of stuff. It was a response to the conditions on the ground. Prices are an important signal in the economy to change behaviors and to be, the efficient allocation of resources. And it looks like we've gone through that piece now, and it's back to somewhat normal. The good news is that long trend is upward sloping, and that's part and parcel why equities are upward sloping through time, right? And that's productivity gains largely embedded in there.
What is your take? Is the U.S. market, though, dangerously concentrated in these so-called Magnificent Seven stocks?
If the U.S. market's dangerously concentrated, then every index is. Right? We talk about 65 and 70% concentration in Canada in 3 sectors. That has been for decades. You think about the Dutch market or the Swiss market, right? And Japan. The heavy concentration comes around, it gets to extremes. We're certainly at extremes for the Mag 7. The good news is we've changed the acronym now, right? We can swap out the Mag 7, take out Tesla, put in Eli Lilly, perhaps. I don't know that it's anything to be particularly concerned about. It's an opportunity. We look at the 493 other stocks in the S&P 500, and the concerns around valuations, the concerns about earnings expectations all look a lot more attractive in that space. And so we've been taking steps to try and move away a bit from some of that momentum. We rely on our active managers to do that and find opportunities in the large cap non-Mag 7. Listen, I wouldn't be shorting them at this stage. They're phenomenal companies. All right, and the earnings certainly have been coming through by and large. but plenty of opportunities outside as well.
Cisco, a former tech darling, obviously overshadowed in more recent years, the stock dropping about 4% in the aftermarket, cutting its revenue forecast for the year and laying off about 5% of the staff, although the dividend is going up about 2.5%. But the profit did beat expectations, but it looks like they're cutting their revenue forecast for the year. It's interesting. We just see these job cuts coming, don't we, across industries?
Yeah, which gets back to the profit margin story. That's a pretty common narrative we've seen across a number of companies in this reporting season, right? Some job cuts, the dividend hike coming through, which as long-term dividend growth type investors, we have a real affinity for that. It's been out of favor for a number of years. It looks like there's a watershed moment now where technology companies like Meta, right, initiating a dividend. No longer is it viewed as a negative if you're a tech company to pay a dividend.
Yeah.
The old mantra was, what are you telling shareholders? We don't have any more good ideas.
Yeah.
Well, no, you've got so much cash flow.
Yeah.
It's okay to give a little bit back to shareholders today.
Used to be seen as weak, maybe
Yes.
paying a dividend.
Well, it's quite the opposite. It's a good signal from management in the strength of the company going forward.